Always like to start off the week with just a discussion of kind of what we saw happening to the stock market. Here's the S&P 500 going back to the beginning of last year. That red line kind of shows that what I call the downward trend line that we've been on since that period of time. The blue line is the 200-day moving average, and then this line right above my head is what we call the 50% retracement line. So if you go from the bottom of 2020 to the top of the beginning of last year, we hit in October 13th, we hit the low, halfway. We took half back. And so that can be kind of significant. It may not hold up. We'll see how it goes. But this year has started out a lot different than last year. If you look at the very beginning of this chart, that was January of last year, kind of straight down all the way through. And they have a thing called the January effect, so how January is, it sometimes will affect the rest of the year. So a positive January can be a positive thing for the year. That sounds great, because last year definitely was accurate. A negative January turned into a negative year. Now, this is the second week in a row. It looks like we're going to have a positive rate of return. So that's kind of exciting. And you can see we're bouncing right up to that 200-day moving average. Again, we've hit it a couple times here, in the last few months. We have not been able to hold above it for very long. We closed twice above it and still fell back down. But this is a really unique environment. We would love to see a reversal of primary trend. Mm-hmm. So primary trend right now is down. So those ones that are going up are considered the minor trend. And the reversal of primary trend would come in a variety of ways. Let's break that 200-day moving average. Let's break that red trend line. Let's establish a new high, because all of the highs are lower, right? Let's get a higher high. Those are the types of things that we're looking for. Now, lots of talk out there right now about the fact that the earnings reports that are going to be coming out are going to be worse than expected, and that's going to drive the market down to a new low, right? That is the message that we're getting from the institutions, from the all kinds of articles about that. Now, one of the things that's kind of fascinating is oftentimes, something that's discussed extensively doesn't actually have the impact that people think it does. It tends to sometimes go the opposite direction. I've seen several surveys of institutions where right now, Bank of America had one this week where they were talking about the big institutions and hedge fund managers have lower allocation to stocks than they've had over the last 72 years, which is a good sign. It means, number one, people have already sold a lot of their stocks in that regards, and also it means that there's a lot of money that could rotate back into the market if it does start to go. So we did kind of kick off earnings season today.
Yep.
The big banks are reporting today, Citibank, JP Morgan, Wells Fargo, Bank of America, et cetera. For the most part, across the board, they beat expectations, did pretty well. This is for the fourth quarter for last year. But the stocks were a little bit soft today, partly because of their future outlook, right?
Yeah, they projected some softness going into the year.
Yeah, mainly because of fears of what the recession, if we have one, what it will bring, especially in the area of loan losses, right? Because they've got a lot of loans out. Ironically, the thing that drove the revenues was actually increased revenues from loans because they're charging higher rates. And so, it's really fascinating to watch how that plays. But that's the beginning. And so now we're going to go through, about 5 or 6 weeks here of earnings reports coming in. This is going to be fairly critical time period. And I suspect that it probably won't be quite as bad as everybody thinks, just because everybody thinks it's going to be bad. But it will be spotty. There'll be certain companies, like even last year we saw, Nike and Federal Express, good earnings, good guidance, both went up like 5%, 12%, and then we saw Micron, come through. I think it dropped 14%, and then so Micron makes semiconductors. And really the big difference is you're probably going to see companies that make goods suffer because people aren't spending as much money on goods. I mean, semiconductor especially. I mean, we bought a ton of computers in 2020.
Yep.
Everybody went home. Everybody was running around buying them for their kids so they could do their Zoom classes and iPads and all of these things. And we don't need them. We're pretty much stocked up on computers for the most part. So, that there's an obvious softness that's going to happen there as far as that goes. But really, it's a redistribution of money. we're stuck at home. We can order from Amazon. Now we're not stuck at home. We can go out to restaurants. We can go travel. We can go to Hawaii. We can do different things with our money that we couldn't do in 2020. So the pressure is going to come in services, and we're seeing goods kind of fall off. So I think that's what you'll see in these earnings reports coming out is kind of the service areas doing quite well, and banks sort of fit into that category in the loans and what have you, and the goods area is doing quite poor. I think we'll see some volatility because of that, right? Just because, every company, and we saw that at the end of the year, just these big jumps one way or another based on what's happening. So that's what we have to look forward to here in the short term, is that earnings coming up, but really powerful motion in the market right now. I can't emphasize enough that this little upturn that we have, how powerful it has been. We track the number of stocks that are above their 10-day moving average on the New York Stock Exchange and the NASDAQ. 82% are above their 10-day moving average. That is the best that we have seen in this entire chart time frame here, going back to the beginning of last year. And so there is a lot of motion. I mean, the breadth, new highs, all of these things are showing, and there's a lot of green. Even when the indexes have been slightly down or slightly up, there's been a lot more power going on behind the scenes. Small caps are running. That's a good sign, because usually that means risk is happening and people are getting into it and what have you. So very, very powerful motion that's happening right now. May not be enough. We saw some very powerful motion back, last summer. That didn't work out. But it's nice to see it. Certainly makes a difference versus what we were seeing at the end of last year, right? And so one of the drivers this week was inflation. So they were, the CPI report, Consumer Price Index, was reported on Thursday. This is what they call top-line inflation, year over year. So if you look at this December versus where it was last December, all right, prices are up 6.45%, which is still too much. But way better than the 9.1% that we were at in July. So trend matters here, right? Coming down, coming down, coming down, coming down. That's fantastic. And so that helps because the Federal Reserve can maybe slow down their rate increases, and the market can kind of settle in on that, and we can see some decent pieces out of that. Well, but the Federal Reserve mainly looks at core inflation. And so core inflation, they take out all food and energy items out of the basket of this consumer price index, and it is down too. Now, it's got a little different pattern. It actually peaked in the October timeframe, not July, like headline inflation. But it's down to 5.71. Good pattern, good direction, excellent. I think this CPI report was really good, going in the right direction.
Yeah, and you might have not seen as big a jump as we usually do with CPI reports because everything was kind of within expectations.
It was exactly at expectations. It was kind of amazing. And we already had a run-up prior to the report on Thursday, so we didn't get the big pop. I remember we had a 5% day back in November on that report from October because it was really a surprise. This didn't turn out to be a surprise. Still good. Right, I mean that matters too, and then this chart's a little confusing here, but this is the headline inflation month over month. Instead of looking at year over year, you're looking at this last December versus the last November. Now that's actually down. So we had depreciation on the basket of goods. Prices dropped a minuscule amount, negative 0.08%. But again, trend matters, and we need to see that. And you can see earlier on in this 1 year period here, there was some pretty big month-over-month jumps, over 1% there. That's a lot, right? So that's again a piece, and that was expected. The expectation was, met here. And so again, the inflation report was really good. I think that's super important. The focus seems to be shifting now to recession and how that might impact earnings, and these rate increases that have already happened. How does that impact earnings? And that's what we're going to be talking about and what you're going to be hearing about a lot of right now because we're getting into earnings season. And again, the expectation is that we will establish a new low below what we already established on October 13th because of the earnings that are going to come through from the first 2 quarters of this year. We would hit some new low sometime in those first 2 quarters of this year. Let's see what happens, right? I think that's going to be kind of interesting. But let's just stay a little bit on the inflationary aspect, because I do think there's a long-term portion of this that's going to come back around. Because I think personally that the situation with the recession is going to be potentially lighter, okay, than what it could be. It's not going to be like 2008, primarily because the banks are in decent shape, businesses' balance sheets are doing okay, household balance sheets are actually better, all better than they were in 2008 before that big downturn. But also China has now released their zero COVID policy. That's the second largest economy in the world. Those people are going to get out there and start traveling. They're going to go through their COVID wave, probably 6 to 9 months of misery there. But once they get through the other side of that, that's a group that's going to be contributing that hasn't been contributing yet. And I still say there's this big pent-up demand. I have a lot of clients. I'd say about half my clients are still very conservative in terms of what they're doing. They're still not out there fully participating in the economy. They're not traveling like they used to. They're not going to restaurants like they used to. That's probably going to become a smaller and smaller portion of the practice at some point as people do start to get out there. I know I've been pretty conservative, but I know that probably as things get better, I'll get more aggressive in terms of going out to eat and those type of things.
Yeah, it's like dipping your toes in a pool. You get used to the temperature after a while, and
Yeah.
then you fully get back in.
Yeah, exactly right. And so I think those are things that are going to mitigate the power of a potential deep recession. And I think that could keep it shallower. And I'm not sure recession will be the really big portion of this, with a couple caveats. Number one, the Federal Reserve actually looks at the data and doesn't over-raise rates. And unfortunately, they have. They over-raised rates in 2000, they over-raised rates in 2008. So they have a history of over-raising rates that scares you. And whenever they speak, they keep saying we're going to go up to this rate and we're going to keep it for this long. And if you look at the bond market, it says, no, you're not. It says you're going to be slightly below that rate and you're actually going to start to come down before you say you're going to come down. So if they follow along with the bond market, maybe things work out. But if they actually execute what they're saying, that's scary a little bit in terms of what might happen for recession. So the part that's hard to determine is, are they saying those aggressive things to try to keep the stock market from running, or are they saying it because they believe that's exactly what they're going to do? So we're going to find out. That's something we're going to, determine as time goes on. But if we look at it, if we look at inflation and kind of break it down, I think there's some interesting pieces here. This is a chart we showed you before. Blue line is goods inflation, yellow line is services, right? And then the total is the green line. If you look closely, that blue line, you can see it peaked out, right? Yep. It's actually coming, flat. We're seeing some depreciation there in goods. I mean, Tesla just announced some more discounts on their cars, and I think we're going to see continued depreciation, disinflation in deflation, in the area of goods. But look at services, still going up.
Yeah.
And again, people are shifting to that. When we look at goods and we look at what we can do to solve inflation in goods, we would probably be looking at the supply chains, and we're probably looking at China, because they are the supply chain of the world. And so that theoretically is going to get better here at some point in time. But it's already sort of solved itself because people aren't buying goods as much, they're now buying services. When we look at services, the key criteria and the main restrictor is going to be labor, because that's what provides, that's who does the restaurants and the airlines and the hotels. This is a labor intensive arena. And so we have a shortage of labor for what is happening right now. And if you want inflation to continue to come down and get back down and the Federal Reserve to be able to back off, labor has to get better. And so this chart is quite fascinating. This is the labor force participation rate. This is going all the way back to the 1950s. And so it's really kind of fascinating. Even if you look at it from an early time frame, the participation rate was quite low because there was always somebody at home, right? And then it grew. You can see that growth coming all the way through, 70s, 80s, and 90s, and it peaked out in the late 90s. And so these are non-institutionalized civilians, 16 years and older, who are working or looking for work. That's what labor force participation is. It's a percentage. It was around 67% at its peak, and it's around 62% now. But if you look at that big drop that happened in 2020, right? Big layoffs, so people were out, and then it's jumping back up. But we're not back to where we were prior to the pandemic. It's about a 4 million person differential. That's a problem for service inflation.
Yep.
That gap needs to close. And the Federal Reserve, Chairman Powell, mentioned this in his last meeting. About 3 million of those people that were missing are being attributed to early retirement. People that, the pandemic hit, they didn't, want to go back to work, and they just retired early, for all kinds of different reasons. And so how do you fill that gap? That will be the thing, I think, that if that gap can fill, we can have services that come, we can have a booming economy, we can have China come back into the fold and not have high inflation. If we can't fill that gap, that boom's going to create inflation. The Federal Reserve's going to keep going with rates. That's going to be problematic for the market.
Yeah, one example is you can look at the UK with Brexit, how they actually had a decrease in their population after Brexit because people were leaving the country.
Yep.
And they're having a lot of issues with labor. So you can crank up your immigration, or you can kind of figure out ways to be more efficient, as we've started to see with, self-checkout,
Yep.
at your local grocery store, or, even fast food places are thinking about automated, like robotic cooking for their food.
Yeah. Actually, we were just seeing this week, we're seeing some of the robotic investment arenas starting to pop up right now. I mean, that just kind of came up on our, screening process. And, you go to the grocery store, the self-checkouts have been expanding, again, like you said, the McDonald's, there's a lot more kiosks there. And so that's one of the ways they're going to fill this. It's probably a potential investment arena also, because, again, if I'm McDonald's and I have people that want to buy my food and I can't get people, I'm going to do whatever I can to get those people, including paying more, which is inflationary, but also investing in technology to try to replace those people and fill that gap. Because the trend is there, and the big part of that trend, because it isn't just the pandemic. The trend started back in the late '90s in terms of this decline in workforce participation, and part of that is just retirements. So the baby boomers are a big chunk of people, and they've been retiring at normal rates, but it's a lot of people, and that creates this workforce that's smaller behind them. If you look at a demographic chart, you have this huge jump in baby boomers, and then there was a pretty big drop. And they delayed slightly versus future generations, or previous generations, child, years. And so there's this big kind of gap in there. And then there's another big jump from their kids and grandkids. But and that's kind of what we're seeing here, this dip. And we need people. So immigration, all of these things. So I think this is going to be very fascinating to see how this plays out. So my last point is just one that I've been trying to make with the clients. And that is to really kind of be able to kind of see the big picture on how investing works, at least as far as I'm concerned. And I call this the super cycle. Okay, so this is the Vanguard Total Stock Market Index, which we use as our main benchmark. It has the majority of the U.S. stocks in it. This is the ETF version, which is ticker symbol VTI. And what I consider a super cycle is the bottom of the last downturn to the bottom of this one, right? And I don't know if we're at the bottom yet, right? We hit the bottom so far October 13th of last year. Maybe we hit a new one or what have you. But what I've been trying to communicate with the clients is that, look, that your total rate of return during that super cycle is really your rate of return. That's what you should focus on. It's not, hey, that great year that you had or this terrible year you had or whatever it might be. It's the total return over each one of these super cycles. And it's also the understanding that these aren't going away. We will hit a low point at some point in time here, and then we will take off again at some point in time. And then again, of course, we will have another downturn in the future. Now, the reason that you want to kind of understand that, because I think it helps you to stick with it and not get too nervous about what's happening, because the returns can be fantastic. This has a 15.7% annualized rate of return, right, over that time frame. $100,000 invested March 9th of 2009, which was that low point in VTI, at 15.7% is $770,000. So that's pretty good. You want to keep up with inflation long term, you just make sure you're in for the super cycles and understand that, you're going to have these downturns as part of that.
Yep.
So, and that rate of return includes this downturn we've had so far, right? So again, could go lower, probably not done with the super cycle, who knows? But nonetheless, my point is just kind of understanding, again, this is part of the educational component of being an investor, is understanding how it works. It's not a straight line. Unfortunately, it's not a CD. CDs are great, and they're paying more than they used to, but they don't keep up with inflation, right? So if we want to keep up with inflation, we have to invest in these types of things. If we invest in these types of things and we want to be good about it, we have to understand kind of how it works. Yeah? And that I think that's important. So anyway, that's what I saw happening this week. It's kind of a summary of what I see going on right now. Things look great as we see it right now. But I tell you what, over the next few weeks, as we do these summaries, it'll be very fascinating to see what the market does in this earnings season, because we've been waiting for months for this particular earnings season to happen. Lots to talk about this. Very important time frame. So we'll see what happens there.